stocks particularly high, or was that just a pipeline filling?
That's a really good question. I wish I had a really good answer. From what we could tell of those port stocks that went up, most of it was hardwood, not softwood. So I just don't think there might have been enough softwood supply out there. When they went to buy it, it wasn't really there, and that's why those prices shot up the way that they did, because some of the softwood mills were having production problems. BC was having production problems. I've got to think, though, that right now softwood stocks are overbuilt in China. I wish I had better data. Wow. Thought there'd be more questions.
I've got a question for you, Rod. As a good friend, I didn't even prep you for this one. There was recently an article on RISI written by one of the financial analysts talking about the OPECization of the global hardwood market. And there's a lot of rumors out there about potential consolidation in Brazil. And just interested to get your thoughts on what the practical consequences of such consolidation would be for not just hardwood, but eventually for the softwood markets as well.
Yeah. I purposely didn't write anything because I didn't want to address that. Okay, you put me on the spot. Okay, so looking at it from a free market economist point of view, Fibria has 10% of the hardwood market. Suzano has maybe 5%. So that's 15%. If they get together, that's just of the hardwood market. So of the total market, it's about 8%, 7-8%. I don't think it's going to have any impact. It would have to be a lot more. I mean, if you look at the U.S. containerboard market, for instance, the top 3 producers had to get up to about a 75% share of the market before it had any real impact on the market. It's hard for me to imagine that pulp will ever get like that, because it's a worldwide commodity, first of all. Containerboard is not a worldwide commodity. It's a regional commodity, so you can have concentration on a regional level that can impact the market. On pulp, you have to have worldwide concentration, which I think very difficult to do. The one thing that it might do is that if Fibria and Suzano were both looking at adding a new pulp line, there would be only 1 instead of 2. So it could be a factor on the supply side, even with the smaller, relatively small concentration.
Okay, do we have any more questions before we move on to the next speaker? Okay, thank you again very much, Rod. Good job. Okay, moving on, I'm happy to introduce our next speaker. He's a great guy, and Stefan Blythe. So Stephen is a Vice President and CFO of Sappi Europe. Prior to being at Sappi, Stephen spent several years at KPMG and also held several senior finance positions at Sappi. Stephen originally hails from South Africa. From personal experience, I can say that there's only one thing tougher than a CFO, and that's a South African CFO. My colleagues are probably laughing at that one. Anyway, Stefan, I look forward to listening to you speak about minimizing exposure to volatile pulp markets, very apropos following Rod's presentation. Stephen.
Thanks, Matt. Thank you, Matt, and good afternoon, ladies and gentlemen. Rod has set us up quite nicely. The volatile pulp markets, what are we as corporates? What can we do about it? So I've structured my presentation today to look at, well, firstly, to remind you a little bit about what Sappi is, globally and in Europe, in the region that I represent. Look at our pulp position. What are the risk areas that we face? And then the big question, to hedge or not to hedge? And that's really what this presentation is looking at, the financial hedging of our risks. What are the tools that we can use? And basically, where are we today? And maybe just share some practical insights as to what we've done within Sappi and what other corporates, I guess, have done as well to look at your pulp position. You heard a little bit this morning on Sappi, that we are a South African multinational listed in Johannesburg with our headquarters there. The European headquarters is in Brussels, and we focus on mainly coated fine paper and packaging and specialty papers, whereas the group has exposure to dissolving wood pulp, as most of you know, and the coated fine paper and the specialties, as mentioned. Some numbers. As a group, we produce, or we have capacity to produce, just over 5.5 million tons of paper. Of paper pulp, 2.2 million tons. And importantly for the group, biggest growing market, specialized cellulose, or dissolving wood pulp, as we call it, of 1.4 million tons. And that gives us, last year for 2017, an EBITDA just shy of $800 million. For Sappi Europe, the region that I'm responsible for, together with Barry, me on the financial side, Barry overall, you can see there with our 10 mills and our 14 sales offices in Europe only, we have a paper production of a capacity of 3.7 million tons. A paper pulp production capacity of 1.1 million tons. And it doesn't take long to do the maths. You cannot produce 3.7 million tons of paper with 1.1 million tons of pulp. So we are short of pulp. And therein lies the challenge for us as a European operation within the Sappi Group. Now, if we look at the group overall, and this is publicly available information, we typically look at what we call our pulp balance. Now, this is an economic balance, so this is not showing volumes, it's showing US dollar figures. And we structure and we run our group according to regions. So we have Europe, North America, and Southern Africa. So as a European, you see we are short of pulp, about $500 million, and these are 2017 numbers. South Africa, very long in pulp, and North America, slightly long, but more balanced. So overall, as a group, we are long in pulp. So what's the problem in a volatile pulp market? The problem is that these are different types of pulp. Paper pulp in Europe. In South Africa, largely dissolving wood pulp, not only, but largely. And in North America, it's both. We also produce dissolving wood pulp at our mill in Cloquet in North America, and we have swing capacity between the two. The real question is, as a group, do we understand the drivers of the price behind all of these different pulp prices? We've seen the predictions from Rod, we've seen many other forecasts, but do we really understand what moves these prices, either alone or in combination with each other, and what are the correlations? Now, very busy slide, lots of lines, but just to run through it, and many of you can draw these hardwood and softwood pulp prices, I think, with your eyes closed. We've seen them so many times. The blue line is the European NBSK price. Okay, I don't think I have a pointer on here, but I think you can find it on the slides there. The red line is the BHKP price in Europe. And then the two other lines, the green line and the purple line, which reflects the cotton linter pulp prices. And those are prices and indices that we follow because they have an impact on our dissolving wood pulp business for the group as a whole. Now the question is, what is the correlation between all of these? Do we really understand that? And I can openly say, as a group, it's very difficult with all the different dynamics that go into these prices to say that, yes, we do. One thing is for certain, when we overlay some of the paper price indices, and I've taken coated wood-free reels and lightweight coated, simply because those are quoted on FOEX, just to demonstrate the overall principle that a lot of us face in the industry, and that is that the volatility of the pulp prices is for sure far greater than our ability to transfer those costs to our customers. So what can we do about it? What are the tools that we have in our toolbox? You could set up a global procurement organization, leverage off your economies of scale. Now, some of these are basic things, so please forgive me, but I'll run through the list, and many of you have them in place already. You could set up strategic sourcing alliances, as we do at Sappi, with non-competitors who are buying the same material as yourselves. Look for multiple suppliers. That's a basic. Of course, most of us do that. It's becoming more and more difficult in some areas of the paper industry where there are close to single suppliers, but of course this is important. Fixed price contracts. We do that to a certain extent. In the pulp market, it's not so easy though. We have done some in the past, but that's not so easy, particularly in today's market. Working capital buffers, and this is typically, it used to be the Chinese methodology: buy 3 to 6 months of pulp in advance, store it, keep it, and ride out the volatility. For many of us who are parts of listed groups where cash is not for free, there's a cost to that cash, and we have working capital targets, we have KPIs to meet. This is not always an option. Some of us do it, and some of us do it on a smaller scale, but it's not something you can employ as an overall policy. And then there is financial hedging. Now, I think it's safe to say most of us within the paper side of the paper and packaging industry, when we look at hedging, we typically, most of our efforts are concentrated on the energy side. We've seen many benchmark studies in the past, and energy is the one area where most companies, either through being self-sustainable or investing in their own energy production, or through trading on the markets, be it electricity, be it gas, even coal, where there's really active trading and hedging, not just for the next 6 to 12 months, but 24, sometimes up to 48 months out. That doesn't happen on the pulp market. So what do we as corporates, what do we do about it? Now this quote from Warren Buffett is a very famous quote, but it was more linked to the financial crisis and the subprime loans in North America, which spread to the rest of the world in 2008 and 9. But if today you are an unintegrated producer who has very little price elasticity on the selling side, and all you're doing is waiting for the pulp price to come down to manage your margins, then to a large extent you are essentially swimming naked. Now, there are those who take the view that if you don't hedge, you are gambling because you're just subject to the vagaries of the market. There are others that say that if you do hedge, you are gambling because then you're locking in a position. Rather ride it out with the market because then no one can point a finger at you. And I've heard many times people say, not just the CFO, but others, that no CFO was ever fired for not hedging. Because if you don't do anything, that's the easy decision. Because then no one can point a finger at you. It's difficult to take the decision of what and when to hedge. So why would you hedge? So what drives us and other industrial companies to hedge our commodity exposure? Firstly, and most importantly, certainty. Certainty of, for us as a buyer, costs, but also for the producers on the selling side, but cash flow. EBITDA and cash flow, some of the most important metrics that drive many of our businesses in terms of the way we are measured internally, but also externally by shareholders and analysts. For particular projects that are being put in place in CapEx investments, you want to make sure you get the returns that you've promised your board and you've promised your shareholders. Protecting shareholder value. There's nothing, for those of us who speak to analysts and shareholders, we know there's nothing more they hate than volatility and uncertainty. They want a reasonable projection of where companies are going. So this hedging, although at the moment we can only do it to a small extent, it does provide a little bit of certainty. If you do hedge and you lock in certain values for your raw materials, you then take that concern away from the business and let them run with the operations on the other things that they can actually influence. And if you put certain hedging structures together, you can have some quite creative pricing structures, which allows you a little bit of flexibility, but while also locking in some certainty. Why would you not hedge? And these are just my own personal opinions, but also from speaking to some people as to why they would not go down this route. Some might not know or understand the risks. I think this is highly unlikely, particularly in this industry. I think everybody's very aware of the risks that we face. Some people know the risk, but they think it's trivial because the prices will come back. And the last 12 months have been a very different experience, but prior to that, the volatility was always there, where we had ups and downs, and when there were ups, we knew they would be followed by a down. there's a perception that there's a big cost attached to it and that it costs too much. But there's a price that you pay for certainty. You could lock in prices, for example, above current market prices, and I'll show you some slides just now. In the longer term, that could prove to be a very solid decision. So there is a perception that there's cost attached. And here's the cyclicality. There's the thinking that, well, if I hedge now for a long period of time, I'm going to be stuck with that, and if prices reverse, I'm going to be caught. It depends. You can have different tenors. You can have 3 months, 6 months, 9 months, 12 months, 24 months. So you can tailor your hedging strategy and approach to the period of risk that you want to take. And this is particularly important nowadays where current pulp prices are, is that if you lock in pulp prices now, there may be some thought that you're locking in a margin which is currently unacceptable. So I think many of us in our industry at the moment, our margins are not where we would like them to be. And if you want to lock in a margin, you don't want to lock in an unacceptable one. You want to lock in one that you can sit back and feel comfortable with and concentrate on the rest of the business. Also, people, human nature, they don't want to lose out on the upside. If I lock in this and the prices go down, then I could have been better off. But most importantly, in this market, for financial hedging, there's a lack of liquidity. There's a serious lack of liquidity, and that sometimes prevents people from actually dipping their toe in the water. And it's one of those, it's chicken and the egg, and I'll come on to a little bit later, but even if we start small as an industry, a little bit, you don't have to bet the farm, but just start a little bit and create that liquidity, and it benefits everybody through transparency and through ability to project future pricing. Now, I've taken some, these are general numbers, they're not Sappi specific numbers, they're expressed in percentages, just in terms of coated paper. Many of you will be familiar with this. Around half the cost of a piece of paper or a ton of paper is fiber cost. Around 30% coating and fillers, 12 to 15% energy, and there's some others. Now, the active hedging that takes place currently within our industry is really on the energy side. There's a few fixed contracts through some of the coatings and others, but very little takes place on 50% of our raw material costs for those who are unintegrated. Of course, if you're integrated, it's a different story. Now, this is a very interesting slide, and this is put together from Hawkins Wright and together with the World Bank, just looking at the change in global commodity prices, percentage-wise, from October 16 to 17. There we see the two top commodities, BKP and NBSK, and these are Chinese net prices. The percentage move year on year, 40 to 50%. Of course, that has been supported by dollar weakness. That's always a tailwind for the commodity prices. And as mentioned by Rod as well, we've had some unforeseen supply outages, which also supported some of those prices. But if you look down the list there, a lot of those commodities are part of active financial hedging markets. I've just listed a couple of headlines which we've all had to deal with and read over the last 12 months. The pulp producers are making, it was mentioned this morning, but somewhere between 50 and 60% EBITDA. Their customers are making sometimes single digit, and their customers are making close to break even. Is it sustainable? Question mark. The capacity management, the unplanned outages that we've seen, there has been some concern expressed in the industry to the extent those are followed by price increases. And we have seen some insolvencies in the European paper industry recently, in the last couple of months, in fact. Some of them pointing directly to the price of pulp. Now, if we take a step back, not pulp specific, look at the global derivatives market. Now, derivative is a financial instrument that derives its value from an underlying, essentially. So we all know about equity derivatives, interest rate currencies, and commodities, be it from oil, coal, soya beans, whatever. But currently that represents just nearly 30% of the global derivative market. So this is not a small market. In terms of number of contracts, we're talking about nearly 6.8 billion contracts in the derivative space. Now, you have a physical market and you have a derivative market. Typically, your derivative market is bigger than your physical market because you have speculators involved. You have people taking positions who are not directly involved in the market, either buying or selling, but they're indirectly involved because their products that they buy are influenced by the underlying prices. In copper, for example, the derivatives market is 40 times the physical market. Aluminium, 30. Oil, around 30 times the size of the market. And in pulp, which is approximately 70 million ton market, less than 10%. So if we have one thing, we definitely have scope for improvement on this side. There's a lot that can be done. How can we do it? What are the mechanisms that we have available? What are the tools, essentially? So pulp swaps and options have been around for nearly 20 years. Most of the activities have been bilateral between buyers and sellers, normally with a third party, typically a bank in between, up until today. Very rarely have there been speculators in the market, like they are in the other commodities, like oil, whatever. Typically, they are set, they're tied to an industry benchmark. So in Europe, it's NBSK and it's BHKP, for us that we typically use, and the others mentioned there. And you would settle them on a monthly basis in cash. So you would take a position for a period of time, you would have a monthly volume, and then there would be cash that changes hand at the end of each month, typically, for however many months you have entered into the contract. Now, until recently, as I mentioned, most of these have been between a buyer and a seller, but with a third-party bank in between. In the past, some of the banks used to take exposure on their own balance sheet to try and create liquidity in the market. That is happening less and less so. Normally, if a bank provides you with a derivative, they've got somebody behind them who's on the other side. Up until a couple of years ago, we never had an option to trade on an exchange. Now we have NOREXECO. NOREXECO is essentially a market that we can trade futures and derivatives for pulp. We use it, and many others use it, but not enough. The liquidity is not what it should be. So typical transaction size is normally between 500 and 3,000 tons a month, and anything from even 3, 6, 24 months. Now, you might think 3,000 tons is not a lot, but per annum, say 36,000 tons if you take one contract, and the forward price goes up by $100, $150. That's a significant amount of money for any region or any company. Just a couple of words about NOREXECO, and I say this because we use them as Sappi, and we know other counterparties that do, but what this does is it offers us essentially an anonymous way of trading in the market. It's the same opportunities. It's futures with financial settlement. It's linked to indices, monthly, quarterly, or annual. And one of the big selling points for this is there's no counterparty risk. So if you're dealing with a bank, the bank has to take credit risk on you as a company, and there's lots of forms that need to be filled in, but there's also a limit to what you can do. Through NOREXECO, you can trade with a blind counterparty on the other side, and the credit risk is not there. The other thing that an exchange provides is a transparent view of what the forward curve is. The forward curve is the price at which participants are willing to transact future business today. Now, the more liquidity you have in the market, of course, the better that forward-looking, or the more accurate that forward-looking curve is. But what do we use that forward curve for? Essentially, it provides transparency. and information from all the participants in the market of where they think the market is going. Like in any stock exchange, like in any forward or futures market, on any derivatives exchange. So it is, provided it's liquid, it is the best predictor of future costs for a buyer and future selling prices for a seller. Also, of course, at the end of the day, you need to account for all of these, and there's market-to-market adjustments that need to be made, and that forward curve comes into play for that as well. You need to book the difference between your mark-to-market and what you hold it at as your derivatives are settled. As I say, provided there's liquidity and depth, that is very, very key. Now, this is an interesting slide. There's no numbers on there, but there's the normal graph that we can draw with our eyes closed of the BHKP prices in Europe, PIX prices. And if we just look at a couple of those examples, what the solid lines show price that could have been locked in for a 12-month period. Now, this is very backward looking, and it's easy to say in hindsight. But it just shows you what could have been done. So if we look at the second solid line there, it's a grayish color. The dot to the left of that shows the time when the decision needed to have been made of, should I lock in a price? Should I lock in that fixed price for those 12 months? Now, at that time, the market price, the blue line, was above the price where I'm making the decision. Up until the point when the contract started, the price had gone up even further. So I guess if you're doing this in a company, people are looking at you and saying, hey, that's a smart decision. You know, well done, you've hedged well. Then as soon as the contract starts, the price drops through the floor, and everyone turns to you and says, well, what did you do? You're costing us money because you've fixed in a price, and now the price is going through the floor. But what you have created is certainty. You're not going to do this for your entire pulp volume, but you're going to do it for a portion of it. So you create certainty of your margin for a portion of your pulp buying requirements. And to the extent you have fixed selling prices on the other side of the equation, which in some parts of our business is the case, then you are locking in a margin. And if that margin is acceptable to you, you do that, and you concentrate on the rest of the business. If we look at the next line, for example, the yellow line, I'll just use one more example. That's also quite interesting. At the decision or the time that you make the decision of the yellow dot, the market price is well below where you are locking in. And it goes down even further. And again, people looking at you thinking, within your company or industry, what have you done? You've locked in prices that are way above the current market price. As soon as that contract starts, the prices shoot up. But you've locked in certainty. It's not about gaining or losing. It's about creating certainty for a portion of your pulp requirements. So those are just two simple examples of typically how far in advance you would need to make decisions, how you lock in, and then compared to the market price movements. I'll give you two examples of trades, one a future, one a zero-cost collar. With any future or swap or any of these, you need 5 things, essentially. You need, firstly, a commodity. You need to understand the tenor that you want to hedge for, the volume that you want, the price that you want to lock in, and the structure that you want to have. So in this case, it's a swap. You're swapping floating for fixed. So I'm paying my supplier on the underlying contract a floating price with the market, but then I swap that floating price with the bank. The bank gives me a fixed price under the derivative, and I pay him a floating price. The floating, in theory, match off, and you have a fixed price that you ultimately pay. And that's an example being $900 that you lock in there. So once you've done that, then you don't concern yourself with what the market price does. You've locked in a price. And so you can do that directly with the bank, or you can do it through NOREXECO. Zero-cost collar, and this is just a combination of 2 different derivatives, one on the sell side, on the buy side, in terms of 2 different options. And there, what's nice about this is you create a bandwidth in which the prices follow the market. You need the same 5 components, so commodity, tenor, volume, and price. It's structured as an option for the cap and an option for the floor. So in this example, your floor is 850 and your cap is 900. So should the market price be anywhere between there, you are floating at that level. Anything above that, if you're a buyer of pulp, you're buying at 900 when the market price is maybe at 950 or 1,000. Anything below 850, you're buying at 850, even though the price may have dropped to 800 or 750. Now, you can manage your exposure here by limiting your time period and the volume that you are looking at. So there's various options. I've taken 2 slides from a survey that was conducted, I think in 2016. Yeah, it was 2016 by Step Change, who we saw this morning. And they asked quite a number of questions. These 2 slides just pull out some of the relevant ones to what we're talking about today. They asked the market, would your business benefit if pulp prices were more stable? There were less off-invoice rebates, in that sense creating more transparency for benchmark pulp prices in the market. And of course the answer predominantly is yes. Okay? We all want transparent prices. Would I consider using an electronic trading platform for market pulp? Now, this was a little bit more divided. And interestingly enough, on the buying side, there were more negative responses than on the positive side. And sellers, again, pretty mixed, hedging their bets. Traders supporting more the buying position. Now, I'll draw a conclusion on my next slide, but it seems that there is an appetite out there for electronic trading platforms, but companies are not using them. And I do question why. There is a benefit to be had, and all the benefits we've spoken about earlier. So I'll just finish off on this slide in terms of a financial hedging approach. Now, I'm sharing some experience of practical steps we've been through internally within our group, but I guess others would need to consider should they follow this or should there be any appetite for this. Important is to create the awareness internally. And I don't think that's a problem. I think most of you do that already, but sensitivity analyses, bringing it up to the level of the board to understand what can actually be done to offset these risks, not for everything, but just to shave off the peaks and then take get some certainty back into your raw material costs. As I say, take it up to board level and understand what their exposure is. You know, when would they start getting itchy feet with the volatility in the pulp market? To what extent? And can you prevent it getting to that point through a certain level of coverage? Then put it into a policy. Draw up a policy like many of us have for energy hedging. Do it for pulp. And get the buy-in from the top. Make sure that they agree to it. And then you essentially then have a hunting license. And you don't have to commit to anything, but you can give yourself a range in which you can operate. Understand the market, that's key. Understand all the banks that will be able to transact in this method with you over the counter, but also understand NOREXECO. Understand how it works, understand how you can trade on that market. And then start. This is my advice, but not, obviously you all have your own views, but I would say start and start small. What this does, it helps create liquidity in the market. It's better for all of those participants. And you're not betting the farm here. You're really taking small positions. And you can then see how it works. See for yourself. But understand that you will never be correct. You will always have, from both sides, you either hedged at too high a price, or you didn't hedge at all, or you didn't hedge enough. So you will never be correct. So it needs to be in a way that you are creating certainty for your business and locking in acceptable margins. And in conclusion, I would just say that transparent pricing driven by market dynamics, it has to be a good thing. It has to be something we all want. And I think by doing some of these things, we do create that transparency and we create that liquidity. So with that, I thank you. That's the end of my presentation and happy to take any questions. Take questions from anyone except Barry, my boss. Yes.
You make a pretty strong case for hedging, and I was wondering, is there an analogy also for currency hedging as well?
I think most of us, as groups and multinationals, we have an element of currency hedging in our business. I would probably say there's no company in this room who doesn't hedge some of their foreign exchange risk. But they can, because the market is liquid, it's global, and it's a case in point that there you have an exposure and you make sure you manage it. Here we have an exposure on the pulp side. Not all of us are managing it in the same way. So yes, there's a clear analogy. Yeah. Okay.
Sorry, just one question.
Yes.
So your slides show that on the raw material costs, the fiber is roughly, let's say, 60 to 80%, depending on what type of paper producer you are, while the energy cost is roughly, let's say, 15 to 20%. Yet, as we have heard, most companies are hedging FX, and some are hedging the energy.
Mm-hmm.
Why do you think that so few are hedging the pulp when it has comparable volatility to the energy side increasingly?
Personally, I think it's more of a liquidity issue than anything else. I think if there was a well-established deep market that people could tap into through an exchange like we have with NOREXECO, I think companies would do it. The pulp market is managed very differently to the way the other markets are managed, but I think that's an historic thing, and I think that it could potentially change. So it's liquidity, and at the moment, I think it's the fear, current prices at least, of locking in unacceptable margins. But those can be managed through tenors, through different volumes, and through clever structuring mechanisms. So does that answer your question? Bernard.
Yeah, good afternoon, Bernard Lombard, Sappi, European Paper Federation, not Sappi. Well, thank you for this very interesting presentation. I must say that over the last 2 decades, I have had people coming to me and saying, well, look at this, prices are very high for pulp, it's time for industry to get equipped and to get into these kind of things. It's already 20 years ago, and it seems that nothing happened that much. Do you think that the paper industry is much more inclined today to go for these kind of things? The minds have changed a little bit, they are much more ready to go into this, first. Second, are the Americans more into these kind of things? Is it something much more for Europeans to get into these kind of things today? Yeah, I would like to get your views about the perception. I know that CFOs don't talk to each other that much, but do you have the perception about what the other companies are doing? Is it something moving forward? Thanks.
It's difficult to talk about the North American market. I'm not too sure how deep that market is in terms of pulp hedging. I don't think it is very deep at all. I think they face the same issues. I think there's certainly an appetite from some buyers to hedge. I'm not too sure that is matched always on the selling side from the producers. Because ultimately, to create a market at the end of the day, you need both sides to enter in. And I certainly think the demand from the buyers is more than the appetite from the sellers. But maybe if we think we've reached the peak of the pulp prices, then that might start to change, because there might be some producers that want to lock in some prices through an exchange, for example. But you don't always lock in at the price of the current spot price, you lock in at the forward price. So if everybody thinks the market's going down, you can lock in a price today, which is maybe $100, $150 below where the current prices are. So that's the kind of thing that people should be thinking about. I thought I was getting away with one question. Okay.
With the other exchanges, like for copper and aluminum, a lot of the participants are speculators. Has there been any interest at all in NOREXECO from speculators, or is it all buyers and sellers, or don't you know?
I don't know. I would suspect that it's buyers and sellers. I don't think the speculators are there yet.
That's how you're going to get a lot of volume, is get specs in there.
Exactly. But they too also want to see some liquidity first. So it is the chicken and the egg situation. Yeah. Yeah. Okay. Thank you. Thanks, Matt.
Thank you very much. Just to tie this back with this morning, it was interesting that the CEO, Diogo, the CEO of Navigator, was talking about his exposure to that BHK PIX index, which is basically, maybe I'm not going to speak for Navigator, but many companies, for example, in Europe buy their pulp and they do physical market indexing to, for example, PIX. And what I think is frequently misunderstood about the services that you can get through an OTC broker or through a company like NOREXECO is that when you're doing a